Welcome you all. The subject name is Financial Reporting Standards and Analysis. From the fourth unit, the topic is Analysis and Interpretation of Financial Statement. Gather financial statement. Obtain the company's most recent financial statement. These are usually found in the annual report 10K filings with the SEC in the US or equivalent regulatory bodies in other countries. Next one is balance sheet. This provide a snapshot of a company's assets, liabilities and equity at the specific point in time. Next one is income statement. This summarize a company's revenues, expenses and profit or loss over a specific period. Next one is cash flow statement. This track the company's cash inflow and outflow, helping to understand how cash is generated and used. Next one is common size analysis. Convert the numbers of the financial statements into percentages by expressing each line item as a percentage of total asset for the balance sheet or total revenue for the income statement. This always for easy comparison between companies of different sizes. Next one is ratio analysis. Calculate and analyze key financial ratios such as, first one is equity ratio. Example, current ratio, quick ratio, to access the company's ability of met short-term obligations. Next one is profitability ratio. The examples are gross margin, net profit margin, to evaluate the company profitability. Next one is efficiency ratio. Example, inventory turnover, accounts receivable turnover, to access how well the company manages its assets. Next one is efficiency ratio. Example, inventory turnover, accounts receivable turnover, to access how will the company manages its assets. Next one is leverage ratio. Example, debt to equity ratio, to understand the company's financial risk. Next one is market ratios. Example, price to energy, price to sales, the market perception of the company value. Next one is trend analysis. Compare the current financial statements to previous period, usually over the last few years, to identify trends. Are revenues increasing or decreasing? Or profit margin providing or declining? Next one is comparative analysis. Compare the company's financials to its comparisons or industry averages. This helps in assessing rel- uh, accessing relative performance. Next one is qualitative analysis. Consider non-financial factors that may impact the company's financials. These includes industry trends, managing quality, comparative advantages and economic conditions. Next one is cash flow analysis. Examine the flow statement to understand the company's ability to generate cash from its operations and its investing and financing activities. Positive operating cash flow is usually a good sign. Next one is risk assessment. Assess the company financial risk, including liquidity risk, credit risk, and market risk. Pay action to any significant conditions liabilities. Next one is investment or credit worthiness evaluation. Based it on the above analysis, determine whether the company is a good investing if you are investor, or a good candidate for existing credit if you are a lender. Next one is report finding. Summarize your analysis in the clear, consist report or presentation highlighting the key finding and your assessment of the company financial health and performance. Next one is subsidiary ratio including investment performance indicates suggest price or equity ratio. From the first one is price to earnings ratio. The PE ratio is the widely used value metric that compares a company's stock price to its earning per share EPS. It helps investor understand how much they are paying for each dollar of earnings. Next one is subsidiary ratio. The term subsidiary ratio is not a standard financial ratio. Next one is investment performance indicators. These indicators can include various measures used to evaluate the performance of investors, such as return on investment, total return, risk adjusted return, and others. Next one is revenue and profitability. Amazing the subsidiary revenue and profitability, which can be in the determined its financial health. Next one is growth perspectives. Access the potential for growth in the subsidiary market or industry. Risk profile. Evaluating the risk associated with the subsidiary operations and investors. The last one is synergy with the present company. Considering how the subsidiary activity complement or assign the present company goals and strategy. Thank you.